While Canada's economy has performed better than we may have expected, given all these major trade barriers we've been facing, is that resilience going to continue into 2026? Joining us now to discuss is Andrew Kelvin, Head of Canadian and Global Rate Strategy with TD Securities. Great to have you here, Andrew.
Thank you for having me. Always a pleasure.
All right, and you got a new report out we want to dig in. I think the Canadian component of this one you guys titled One Battle After Another. Of course, a lot of challenges. What's the base case now for 2026?
It remains a challenging environment in many respects. We still have the suboptimal trading relationship with the United States, but we actually think this is a year we can see Canada start to overcome some of the challenges in front of it. We've seen the government come out with a reasonably expansive budget. It was not the sort of maximally expansive budget that perhaps people expected. And I think really importantly, our assumption is that A, trading conditions between Canada and the United States do not get worse, and B, the impact from the change in trading conditions we've seen, that drag lessens over time. That we see that as something that was a bigger issue for 2025 growth than 2026 growth. So if you layer in less drag from trade, more growth from fiscal stimulus, and hopefully a Canada-U.S.-Mexico trade agreement renewal ahead of July 1st, we think we can see accelerating growth over the course of the year, a little bit better than last year.
All right, so that's a nice base case for us heading to 2026. Let's start to break down those components. The Carney government managing to get its budget passed this week. How big of an impact on this economy are you expecting from that document?
So we think that the budget, with its sort of aggregate new spending of about 1 percentage point worth of GDP per year, can boost GDP growth by over 2025 and 2026 by about 1.4 percentage points, 1.25 if we want to round here, between 1.25 and 1.5. The critical thing is the government does seem to believe they can get the money out the door rather quickly, which means we can see a lot of that growth come in calendar 2026. So we see that adding about a percentage point to Canadian growth next year, which is critical for Canada in the context of an economy where we have zero population growth and therefore quite low trend growth rates. That fiscal stimulus is really the thing that keeps us, we hope, comfortably away from having a 2026 recession conversation.
Is this the kind of stimulus, too, that has a multiplier effect? So it's one thing for the government to put a buck into the economy and get a buck return, but we're hoping for more from this, I think.
We're hoping for more. I think it's honestly too early to say. If you think about some of those large ticket items, there was a small income tax cut in there. That tends not to be something that has a large multiplier through the economy. Given that it was a fairly broad tax cut, you usually see that money spent, but it's not something that tends to create productive investments. There's some new agencies where we've yet to see how effective they will be in incentivizing growth from the private sector. There are some depreciation measures that are designed to incentivize private sector growth. We'll have to see if those ones can deliver more than a buck out for every buck that goes in. The big question I have is there's quite a bit of money allocated to defense spending. Defense spending is going to have an import component to it, and how effective that is in driving growth will depend on how much of that money is actually spent at home.
So we have a Bank of Canada that got a little more accommodative for us this year. We have inflation, there's a bit of stickiness here and there, but it's sort of in the ballpark. What can we expect from the Bank of Canada next year?
So the fact that the Bank of Canada is in accommodative territory is one of the things that does help a little bit growth next year. It's not a huge needle mover, but 50 basis points on the overnight rate does have a positive impact on growth. From the Bank of Canada's perspective, they think rates are about right if their forecast holds. Their forecast is actually quite similar to our forecast for 2026. So it follows that if we are roughly correct on growth and inflation, and we see inflation coming lower through the year, core measures of inflation, I should say. If we are roughly correct on growth and inflation, it follows that the Bank of Canada is probably done here, for 2026 at least.
When they're not done anymore. So for 2026, if they're done, if everything goes to plan, when we come out of that, we still got a long way to go. Are we talking about a bank that will start taking away accommodation if this economy can start growing?
If the economy starts growing, and we can take some of the slack in the economy, so we would expect to see a much lower unemployment rate in this sort of world. But if the economy grows as we project it will, we would see the unemployment rate fall, we would see slack reduced in the economy, and we would expect the Bank of Canada to lift rates, we think starting in early 2027, because we are at an accommodative level of interest rates. Textbook says that if you get back to a sort of at-trend growth rate and you have no slack in the economy, interest rates should be around their neutral level, which the Bank of Canada sees at 2.75. Now, in terms of where the sort of shocks are, because I can have, my sort of empirically grounded, mean reverting model of how the economy is going to behave, but then we can have things come along like trade wars, which models tend not to incorporate. So there's a reasonable degree of symmetry around that forecast if we are incorrect in the idea that trade impacts will be lesser this year. Like if we actually see the same sort of drag and growth from trade in 26 as we did in 25, then we're probably not seeing hikes in 27, and in fact, we could see additional cuts next year. There's definitely worlds where they can ease, but I think you look at the risks as skewed a little bit more towards 2027 hikes than towards 2026 cuts.
Is that the biggest risk for 2026 in terms of that forecast, thinking what the economy is going to produce, what the Bank of Canada will do? Is it those trade negotiations that are coming back up for USMCA, CUSMA?
I think that's the biggest one, in part because there's a wide variety of outcomes. Like my thesis has been for a long time that A, the US government will not take actions that raise domestic energy prices, which should allow our energy sector to continue exporting to the United States without tariff impediments. And B, the fact that USMCA exemptions are in the current sort of trading stance of the United States, it suggests to me that somebody in the US sees some value in keeping these USMCA exemptions. So I expect those exemptions to persist through 2026 until we actually sign the new trade deal, which again, we do anticipate just ahead of the deadline in July 1st. I'm making a lot of assumptions here. If there's a world where there is, as a negotiating tactic, or there is some sort of flare-up in relations between the two countries, we have seen that intermittently in recent months that there will be points of friction that seemingly come out of nowhere. If it turns out that the trading terms between Canada and the U.S. worsen, my forecast is probably too optimistic. The other critical assumption, though, is that the government's able to get the money out the door in an effective way in the timelines they anticipate. It's very easy to put these sort of numbers down on paper, saying we intend to spend X billion dollars by this date. Being able to do that effectively in a way that boosts the economy is actually a difficult task. I have no reason to doubt that the government's going to be able to do it, but it is an assumption that the money gets out the door in a way that boosts growth. That assumption could be that we were too conservative in our estimates. It could be we were too optimistic. There's symmetry around that as well.
All right, we put all of this together. What could it mean for the bond market?
So the big question for the bond market almost has nothing to do with Canada, to be perfectly honest with you. There was a reduction in Government of Canada borrowing associated with that budget, which caught some people by surprise. I think really what that comes down to is the government has fewer bonds maturing next year, so they need to issue fewer bonds to refinance that maturing debt. It's still a big borrowing program, nearly $300 billion. The reductions we saw were more in shorter duration bonds than long duration bonds. So the sort of duration hitting the market in Canada, once you factor in Canada mortgage bonds, once you factor in provincial bonds and all those sorts of things, we see the bond market supply is roughly stable in a world where Canada is pretty rich to the US. So if you were to just hold US rates constant here, my bias would be to see Canadian yields drift a little bit higher, particularly because we also have seen the market maybe being a little bit too cautious in pricing in Bank of Canada normalization in 2027 and 2028. The thing is, we don't think the US bond market is going to be stable here. I think one of the really interesting lessons of the last 12 to 18 months has been that the world's actually able to absorb this degree of government supply. We expect stable US issuance next year in duration terms. Net coupon issuance, so issuance net of Fed buying, is actually expected to fall next year in the United States. We see European issuance essentially stable as well. So we're in a world where global bond markets were able to deal with the amount of supply we saw last year. We think we'll see about the same amount of supply this year. So we think that's not really an issue in terms of markets being able to deal with these large deficits in the US, Europe, Japan, what have you. At the same time, the Fed keeps cutting. And as the Fed cuts, we think US yields will move lower broadly. There are strong correlations between US rates and Canadian rates. So we actually think lower US yields will put downward pressure on Canadian yields. We actually expect modestly lower yields in Canada at the 10-year point. We see Canadian 10-year bonds finishing next year around 3%.